One last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Another big one for stocks. The S&P 500 adds more than 50 points. The Nasdaq and the Russell leading the charge with gains of over 2%, almost 3% for the Russell, 2.7% for the small caps, and about 1.7% for the Nasdaq by the close. Pretty interesting session in which crude oil and gold dropped right at the open, and then we found some buyers of both, but particularly a decent bid in crude that Scott Bauer says we should watch as potentially a sign that investors are going to need more confirmation of that Russian headline about military cutback in Kyiv. So big bullish day anyway. Let's bring in Caroline. Let's talk some more about what we learned in today's session and then bring our panelists in here for some earnings. Let's have some fun here, Caroline, because one of the big movers on the day is a stock near and dear to my heart, Petco. Why are we talking about Petco?
Oh, that's right. I forgot you're a cat person, so you might
That's
go to
right.
Petco or maybe Chewy, which is about to report earnings.
It apparently was National Cat
Petco.
Appreciation Day, and I missed it, according to my Chewy email today.
Oh.
I won't be forgiven.
Cat's going to be so disappointed, Oliver. All right, well, Woof, which is Petco, is having not just a good day. It's up 4.9% today as we head into the close, but a great month. It's up 17% just this month alone. It's positive on the year. But Wedbush added it to its best ideas list. This, of course, comes ahead of Chewy's earnings. Calls it a top-notch retailer and a less discretionary sector with highly visible and strong growth ahead. Says its premium pet care business model is gaining momentum and should deliver long-term gains in the high-growth industry. As I said, it's up year to date. It's up about 3.5% year to date, so outperforming the market. But Wedbush still sees plenty of upside to shares. Outperform rating on Petco and a $25 price target. It's currently trading around $20.50. And as I said, this comes ahead of Chewy's earnings, which of course is a rival. And on that note, when it comes to rivals, Wedbush says Petco should prove even more resilient than rivals due to its exposure to higher spend customers, growing loyalty offerings, unique revenue drivers, and a $1.4 billion own brands portfolio that cannot be found elsewhere. So despite some inflation headwinds, Wedbush very bullish on Petco, and I guess more bullish on Petco than Chewy because of higher spend customers.
Yep. Seth Basham.
Apparently it's luxury, huh?
I guess so.
Maybe you can tell me.
I don't know. It's convenient. I still find it easier just to stop by on the way home than constantly have all the stuff delivered. But then again, sometimes you run a little low on supplies. I kind of got disconnected from Chewy after they had inventory problems during COVID, so I just got used to walking down to Petco. So I guess Seth's got a point here in the steadiness and visibility of their customer base after COVID. $25 price target would be a nice 25% rally from $20 right now.
But here's the thing, Oliver. Do you have a car? Because I guess cats don't eat as much, but are you carrying like big cans? I don't even know.
That's why you got to get the lightweight litter. You can carry that thing around on your fingertip.
Litter is the reason I would not want a cat.
Hey, it's better than following around picking it up like Seinfeld says. If there's aliens watching us from the galaxies and they see one creature making a poop and the other one picking it up, who's in charge? I'll leave it to Jerry. Appreciate it, Caroline. All right, Woof.
World.
The conviction buy. Good old Petco. All right. Well, let's see if Chewy pushes back on that narrative at all. We got earnings coming out for the stock this afternoon. George Tillis and Nathan Peterson are with us. Okay, so firstly, George and Nathan, we've got some earnings to talk about as we wait for Micron. We've got Chewy as well. Looks like Micron's going to be the first report with a pretty big beat here. And we've also got Lulu and RH too, so we got a little retail action for us this afternoon. Hey, George, you a dog or a cat guy or both, or no preference?
I'm a dog guy, OJ.
Yeah, okay. All right, George. What about a Micron versus a NVIDIA? Where do you stand on that one?
Well, NVIDIA is a different company altogether. I think, like, if you look at Micron, they're one of the three largest leaders globally for DRAM chips. And one of the things about the quarter, and I think this is indicative of why the stock has not performed very well in the last on a year-to-date basis, is pricing power. That doesn't look like effectively a challenge right now. It looks like they're actually coming in ahead of estimates when it comes down to earnings per share and actually guiding higher, as you see now. That just came across the board at $2.14 was the number in terms of beating the estimate of 1.97. And again, we're talking about EPS growth. That's about 25% on a year-over-year basis, with again guidance going forward for EPS somewhere between 236 and 256, so midpoint 246. That's a pretty impressive increase, and I think that it's indicative of some of the weakness we're seeing in pricing power across PC and smartphones, but still some strength in the industrial automotive space, cloud, as well as gaming. And I think that's where Micron is also flourishing.
All right, that's a nice beat on the trailing and a nice beat on the next quarter in particular for the outlook. The Street was only looking for $8 billion in their fiscal Q3, which is the next quarter. This is the fiscal Q2 they're reporting. And they're saying they're going to do as much as almost $9 billion, 8.9 at the high end, at least 8.5 versus the $8 billion estimate. I mean, we're talking 11% top line sales beat. Nate, how can the market not love this?
Yeah, morning, Oliver. Afternoon, Oliver. Yeah, it's that's a nice guide going forward. I think it does have to do with that pricing, NAND and DRAM, of course, and then I think data center has been one of those elements that they've cited as something that'll be potentially a catalyst for them moving forward. We know they're always trading cheap historically. They're around a 7 PE. Technically, they're just kind of about middle in their range, and so. Some of it might have to do with supply chain issues, and hopefully there, with a lot of the companies that we hear about that will be reporting, there will be some relief there that will be coming in the coming weeks as Omicron and COVID basically dwindle down as they have been on the charts. But yeah, that's an impressive beat. I mean, the implied move was about $6. It's up about $4 right now, so I haven't seen the numbers, but it's with that kind of guidance in terms on the top line that like you were mentioning, that's certainly impressive.
Okay. And we see the response here, $85 and change, 86 almost, as the stock pops. Think that'll be good for some solid strength tomorrow. Follow through for a group that's been trying to get its act together again, the chips. Lulu's out, and looks like we're going to get some bullish activity there too. Hey, you report in the middle of this big rally we got, and it seems like the market's going to give you a little bit more rope than it did, 2-3 months ago in the heart of earnings season when investors were punishing stocks that would beat numbers, and even if they, did come ahead of the estimates. All right, so a little bit of a different vibe here this afternoon. Lulu beats on the EPS, trailing by about 9 cents on $3.28 estimated. Sales did come slightly shy though. That's kind of where this is a distinctly different environment, where if Lulu can miss top line and still hold this rally, then it seems like, George, we're in a very different state of mind than we were 3-4 months ago.
Well, yeah, I mean, if you just look at the price actions, I can see why it's mixed. I mean, $3 million in terms of a miss, that's a rounding error at the end of the day. But the quarter looks like pretty good numbers from the standpoint of EPS, beating the estimates by about 9 cents. So we're talking now EPS growth that looks like it's close to 30+% on a year-over-year basis. And top-line sales, albeit again a slight miss, is still coming in and in the 20+% range, around 22-23%. So overall, I'll be looking to see what they talk about in terms of the international sales growth, because they still have a lot of international penetration going for them. But I think if you just look at the company, and this is maybe why we'll see a little bit of volatility, perhaps even a little bit of a dip in the morning, I can't say for sure. Could be based on valuation. It's still trading at a rather lofty forward multiple, about 43 times earnings for the next year. The industry is at 13 times, but you also have to say that this deserves a brand premium of a multiple. I mean, Nike's at 35 times, but if you look at gross margins for Lululemon, the last 4 quarters at 58%. I don't necessarily see them beating that number. They certainly could, but that's quite a bit above Nike, and then using Nike as a branded competitor at 46%. So they are trading a little bit higher multiple than Nike. The margins are a little bit better when it comes down to gross margins as well as net margins. But I think it comes down to unit economics, and that really comes down to volume growth. And that's, again, where they came in just a little shy of the estimates, and perhaps maybe that's why we may see a sell-off, but we also could see it continue higher based upon guidance going forward, but also the market as well. Not to mention, we know that there's been relatively pretty significant weakness in the name since November.
Lulu, just monster same-store sales, still 32%, especially after Nike saw some selling around its earnings and they're launching the shoes. I imagine they could tell us a pretty exciting outlook here, perhaps on the call. Nate, Lulu still is a premium brand that is demonstrating it can command major sales despite its price point.
Yeah, George is exactly right in terms of it being, just one of those premium brands. I think the question for a lot of these companies, we're in, consumer discretionary here, is as we see these inflationary pressures, how much of those input costs are, these types of companies able to pass on to the consumer, and how elastic or inelastic is your demand? Who is going to make up for that? We know inflation is out there. We know supply chain, labor shortages, things of that nature are affecting and going into those corporate margins. If they're able to pass that on, we know that the consumer generally has a lot of savings, $2 trillion savings tied up. Are they able to hang in there? Are they able to still go in there and shop? And then I think George also brought up over the international side, what about the uncertainty? I think there was a downgrade recently. PVH, they're also reporting about some concerns about some of their sales and their exposure over into Eastern Europe. So that's another equation. So the market's still going to be working through this, and some of these companies are reporting a little bit late relative to what's going on in Ukraine and what's been going on with inflation. But as we move into the thick of Q2, I think we're going to get a better read on the consumer. But this is pretty impressive. I got to say, the stock was up 20% heading into the report from March 8th. And to have a top line miss like that and the stock still up 5%, pretty impressive. I
agree. Definitely agree. The tolerance here is shifted in a bull rally. There's a pretty interesting story out here for RH that complements earnings. A stock split, another one, 3-1 for RH, which trades at $386. I guess AutoZone is the next one we'll be looking for, a $2,000 stock. When are they going to split? But RH has been a pretty poorly performing stock now for the better part of, a year, really, like 7 months, 8 months. This thing's been downtrending. We did hear the case earlier this morning for some weakness or lack of upside. The Morningstar analyst Jamie Katz joined us, George, to talk about RH's cooling growth numbers in a post-COVID world where housing might slow a little bit. Is that what's going on here?
I think so. Look, it is a luxury home and, furnishings and improvement store with their waterworks division, which includes things like fixtures that are higher end. And they do compete with companies like Home Depot in that area. But it's all about the higher end textiles and lighting and bath and design and decor, which is really tied into housing. But I also think it's tied into that K-shaped recovery that we saw, where the more affluent folks who had homes did spend quite a bit more money. Gross margins for a company like Restoration, quite high, close to 50%. But I did notice the short interest on the stock is about 17%. And you can see after hours down based upon, it looks like a miss in sales, quite a meaningful miss. At 931 was the estimate, came in at 903. So they're not going to get a pass for this one overall. And the stock has been down about 32% over the last year. Now, this is absent today's post-market move as well. But again, the revenue, had they come in with that number, is up about 14%. That's, again, assuming they hit the number. So they obviously missed that, with EPS, again, only up about 10%. So we already saw EPS growth challenged relative to sales growth prior to the sales miss that they just reported. So I think, not a bad company when it comes down to balance sheet and cash from operations, at least in the last 3 quarters, are very profound. But the multiple, I think the multiple right now is not preferred in the areas of housing. And this is really tied into it, especially on the luxury end of the scale. And I think that's, indicative of asset prices, interest rates, and things like that.
Okay. So RH having a little bit of trouble here. And the home builders we were just talking about earlier on the show is also having a little trouble. Nathan, it seems like some of the dots are connecting here that one point the market remains concerned about is actually housing.
Yeah, if you look at the home builders, ever since basically 2022, they've been in a downtrend, and you kind of have this mix of factors that are going on. You have those, the higher input costs. We know that steel and lumber and the like are all going up across the board. We did see 19% year-over-year growth. That was back from January, but that's still impressive. But mortgage there's some of these. If you were looking at housing as a whole, and you can kind of throw RH in the mix in terms of some of that spin that might go into that area. We've had this downtrend that's happening within the home builders while demand and supply low, demand high, and prices moving higher. And then you've had the mortgage applications also moving down as well, which is kind of suggesting that, those rising rates are actually starting to dent the buyer there in terms of the demand, or at least create some pause rather than some of the fervor. So, yeah, I'm not a home analyst, but it's going to be interesting to see just how this plays out in terms of how high do rates go. And then are home builders willing to go out there and pay these high costs? They have their profit margins, and they likely have a projection of how high those prices are going to remain. So that remains to be seen. We'll have to see what happens with those input costs, and then what happens with mortgage rates going forward.
I like that point in this morning with housing data in the home price indexes. We saw that rate of change of growth really slowing down, right? Your year over year is still like 20% on the average selling price, but the short term month over month has now gotten down to low single digits. So we are definitely slowing down. It seems the market has a pretty low tolerance for housing connected themes right now, but maybe even lower tolerance still for Chewy. Come on, $51 down to 43. Chewy just got destroyed. So once again, this company fails to impress on earnings, it seems like. Keep in mind the stock did go from 35 up to 50 here just within the last couple weeks, but definitely a big setback. Very clearly shows up on the chart as a rejection that fits right in line with the downtrend, rejection of strength and a breakout. And now Chewy just looks like a pretty standard, deep ingrained bear market over the last year. George, they missed on sales. They're still losing money. This is another one where, it's just how do you lose money still at this point when there are so many people with pets over the last year that signed up for this business? Come on, how are they losing $60 million?
Yeah, so look, it's about the unit economics, and there's no tolerance now for not making it close to break even. Now, if you look at last year's EPS, the expectations for this quarter, 7 cents of a loss. Last year was 9 cents, so they were expected to improve, and that was based upon the revenue metrics at the very least hitting the numbers, which they obviously miss. And you're not allowed as a company to miss when your unit economics are still challenged. In other words, you're inching closer to profitability, but you're not there yet. And so this is the issue. Net sales, I'm sure, per customer are probably not as what we're expecting here. And that's maybe why the stock is down, but it's aggressively down because, again, one of the things about the DTC aspects of e-commerce, now it's a trusted brand to go to, but all the brands are not Chewy brands per se. They do have certain private label brands, but services, that's where they're missing out. And this is where the Petcos of the world are taking over. Boarding services, grooming services, these are things that you can only do on an on-site location. That's where Chewy's missing out. And I think that's the telling disparity or difference between the two companies, not to mention if you look at Petco as a company, financially fit one as well. They have positive earnings per share, whereas Chewy is not profitable. And again, if you miss on top line sales, you get further away from profitability. You don't get closer.
Yeah, its market has not changed its view on that. If you are a COVID-centric stock that benefited from the last couple of years, it seems like the bar remains very high. Nate, I mean, it might be more than that too. To George's point here, maybe the economics don't make sense for this business when I could go down the street to Petco and get more.
Well, I mean, in terms of, pet ownership and just the TAM, in terms of the market opportunity, if you look at the longer term, I know they're estimated in terms of their growth estimates. Yeah. They look pretty healthy. So down the line, you certainly think that could be a factor. But, I think you kind of hit it on the head in terms of, the stock is up 40% in 3 weeks heading into the report. And then B, you miss on the top line. And then I'm also seeing, gross margins down 170 basis point, net margin down 370 basis point. That speaks to the higher costs that they cited last quarter. So you get that 1-2 punch with the stock running up into the report, and then top line and margin miss, not looking good. Okay.
All right, guys. Interesting action here. Chewy still having a lot of trouble, but helpful analysis and contributions from you gentlemen. Appreciate it. George Tillison and Nathan Peterson. A great earnings session here this afternoon. Micron, the big winner and probably the most important one to the overall market. The chip maker is definitely a bigger determinant of where this S&P 500 can go than Chewy, I think, at least. Maybe you'd think, all right, thanks, guys. We got to jump. When we come back, let's talk about a tech business that debuted about a year ago, and we discussed advertising, cookieless advertising, here on the show with the CEO of Viant Technology. Stock has been getting pummeled since, though. Let's find out what's going on.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics, and what drives the stock takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
It was almost exactly a year ago we spoke with the CEO of Viant Technology, Tim Vanderhook, ticker DSP, about cookieless advertising and software behind the advertising business to connected video content and more. Stock has been punished since, though, down 85% in the last 52 weeks. Tim's back with us here on the show. Tim, thanks for coming back to the show. Good to have you here again.
Thanks, Oliver. Thanks for having me.
Okay, so what's happened to the stock? It's gone crushed here. What do you think is the best explanation?
Yeah, I mean, there was an announcement after our IPO that Google delayed the deletion of cookies, and we did see some investors sell off on the stock. The good news for Viant shareholders and our company is that the financial performance of the company was outstanding in 2021. Revenue grew 36%, EBITDA grew 17%, and we grew our customer count by 17% as well. So although the stock sold off, I think what investors missed is where the digital advertising industry is going, and we're the future, and I think our 2021 performance proved it.
So that future of how advertising works and what data is used seems to be more volatile than people thought, with Google pushing that removing of third-party cookies back to 2023. And with the growth numbers that you just cited, how did those compare with some of your earlier numbers when it was expected that Google would take these measures? Did you see any steep drop-off?
No, not a steep drop-off. We've seen an acceleration. Digital advertising is exploding and is a huge market, and there's going to be many winners in this space. Back in 2015, Viant introduced a brand new way to transact digital advertising in one that we call the people-based way. Thinking about people first, no longer relying on cookies given to us by big tech, et cetera, et cetera. And that is the reality of today. Even though Google has delayed it until 2023, Apple has accelerated the shift in the deletion of IDs across their platform. And that's what's driving so much marketer interest in the Viant DSP Adelphic.
Demand side platform, DSP, the etymology behind the ticker. And right now, the growth story then, Tim, if the unique value proposition of the cookieless advertising tech is not going to have that same uniqueness just yet, then what is that main drive? What's allowing you to continue to grow that client base?
Yeah, absolutely. Well, the need for digital advertising is absolutely a huge market and has been growing gangbusters for a long time. It's really that need. Our software enables access to ad inventory that marketers can buy, whether it's on a streaming television, a digital out-of-home board, streaming audio through a podcast. These are all brand new areas that marketers are looking to engage consumers with their brand. Our software enables one-touch access to log in and buy that available ad space. But more importantly, our people-based framework, these IDs going away. What does that mean for everyone? It means that measuring your returns for the person who bought the ad is tougher. And our software delivers on that in spades. So the need for digital advertising is going to keep growing, but a new way to buy and measure those ads, the one that we invented called people-based, is the way forward. This has widely been adopted by not just Viant, but now the entire industry is on this people-based framework as the way forward, but we're certainly the leader. And just the growth in digital advertising is going to continue to propel Viant's growth, both in 2022 and the many years beyond.
Tim, we're out of time, but is there a typical contract length when you sign clients on to your software? Can you give us an idea of maybe what that is, a median contract duration?
Yeah, absolutely. It's SaaS-like revenue. So customers enter long-term agreements with us. We have a 95% retention rate with our customers, but it's an even better business model. Rather than get paid a flat rate fee per month, we scale with usage of our software. And so we saw usage grow 29%. That's money spending through the platform to buy advertising. We guided in Q1 that spend will grow at more than 35%.
Okay.
So we're seeing accelerated usage and things are looking great.
Okay. Tim, thanks for the update. Appreciate it. Looking forward to more.
You got it. Thanks, Oliver.
Tim Vanderhook, co-founder and CEO at Viant Technology. That's it for Market on Close. Have a great night. Your first trade is coming up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo Webcast Series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
After the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Welcome to Your First Trade. I'm Scott Connor, a 30-year veteran trader, and it is Tuesday, March 29th. Now on our show, we've got a lot to cover. First, we'll start out with the chart master, Ben Watson, and look at a stock that has earnings coming up Thursday before the opening, and that's WBA, Walgreens Boots Alliance. We'll put together a trade that aligns with those earnings coming out soon. Then we're going to join Ken Rose and talk about something very important to long-term investors, and that's the concept of yield, returns, and then we're also going to talk about something called the Rule of 72. Good takeaways for long-term investors. And then finally, I'll talk about what happened today in the markets. What happened on Wall Street? Well, all four indices were higher. We're going to talk about what was impacting the market, some data, and a few stocks that were on the move. All right, well, let's start at the very top with today's example trade. And as I mentioned, we're looking at WBA, Walgreens Boots Alliance. Now, this is a stock that's been under a little bit of pressure, but before we put the trade together, the example trade, let's bring in the chart master, Ben Watson, and get his take from the charts of this particular stock. Ben, thanks for joining us here again. And Walgreens Boots Alliance. Now, I think this is one we've looked at before. I mean, most people know this as a pharmacy type company. I think, Ben, 2/3 of their earnings or revenues come from pharmacy sales. So what's happening with the chart of this particular stock, Ben?
Well, I'll tell you what, Scott, what's happening with the chart is very similar to what seems to be happening with the company. One of the things that's going on is there's a discussion about divesting at least part of their Boots holdings, the Boots portion of the Walgreens Boots Alliance, if you will. And what that has led to is a little bit of short-term kind of wait-and-see mode going on here with chart. Of course, you're looking at the long-term chart here, the 3-year, 1-week chart, which is giving you kind of a sense of the fact that in the last year or so, the stock has really kind of stayed in this sideways range in between about the 45, 46 level on the downside and about the 50 to 54, 55 level on the upside. It's made a couple of oscillations around within that space. Now, most recently, Scott, seeing the stock moving really kind of sideways between this 46 and 48 level on a weekly candle basis, seeing a pretty strong bullish engulfing candle on a weekly basis. But here's the thing, going into this earnings announcement, with the price kind of sitting in the middle of this range, this shorter term oscillation range between 46 and 48, 2-point wide range between support and resistance here, there is a little bit of uncertainty perhaps, and that suggests that investors might be waiting to see what the company says on the earnings announcement in terms of, you know, what their future looks like. Are they going to divest that Boots portion of their holdings? And does that suggest some upward movement? The RSI, other types of sentiment indicators kind of giving us the same picture, really kind of sitting in the middle portion of the range, kind of staying fairly neutral, if you will, going into this earnings announcement. And this is a different shape in this chart from where we saw the beginning of the year, end of last year, and really coming out of that pandemic bottom last March, where there was a very strong rally to the upside. We saw some very nice, strong bull flag type moves in the price of the stock, and we just have not seen that same type of bullish tendency in the price of Walgreens Boots Alliance here in the last year or so.
Got it, Ben. It's interesting looking at that 3-year chart you just had, because the stock is not that far from where it was 3 years ago, and that's pretty unusual, especially with the amount of volatility we've had, and of course the whole pandemic that we've been through, that a stock is pretty much sitting where it was. So this stock, it looks from, at least from the chart, it has a tendency to stay within range. So range bound, obviously something we're seeing. I'm looking at the beginning of 2021, and that's pretty much where it was, right about at this level. So 45 to 55, you said, is kind of the range it's been in. I think you might even narrow that to 47.52 to stay inside that range. But so when you have a stock like this that moves in that range, do some of the other factors do you tend to give more weight to some of those other factors? Like you mentioned, RSI looks pretty strong here. How do you factor that in with a stock that just kind of is in this range for such long periods of time?
Well, that's one of the reasons why there are so many different types of technical indicators out there, because when a stock is in a sideways range and it's oscillating between support and resistance, oftentimes sentiment indicators, momentum indicators can get locked into that same kind of sideways oscillation as well. It's when they start to make a move, and oftentimes signals like the RSI or a MACD or some other kind of sentiment type of an indicator can give you an early potential indication that the price may move outside of the range. So if it's gaining some strength, you may see the potential for some upside movement. If it's losing strength, you may see the potential for downside movement. Can be an early indicator, but it's never a guarantee. One of the things we have to keep in mind when we talk about technical analysis.
No, that's actually a good point to bring up, Ben. Now, I think going into this example trade, again, we talked about the range. That was fairly easy to see on the chart itself. We're sort of at the lower end of that range. I have to say, if it was the lower or upper part of that range, it's the lower level. So, I mean, if we were right in the middle, I think maybe I'd be looking or might consider a range-bound trade itself. But since we're sort of at the lower end of that range, we might factor that into the trade itself as well, Ben. All right, well, we'll leave it there. Ben, thanks again for helping us break down the chart of Walgreens Boots Alliance going into the earnings. Thanks again, Ben. We look forward to you joining us again tomorrow for another example trade. All right, folks, let's turn our attention back to the Thinkorswim trading platform. I'm going to go right to the trade tab. I put in the symbol WBA. One thing that's interesting about this particular stock, and again, anytime a trader's considering a strategy, one of the things that's often considered is the price to earnings ratio, the PE ratio. We talked about this a little bit yesterday. It's sort of a way of valuing a stock. So you take the price of the stock, divide it by what it earns, and that's the PE ratio, price over earnings ratio. Now, we talked about stocks yesterday. They were trading in the 19 to 20 or 16%, 16 level. And that's kind of where the market is. And let's say 19, 20, right in that level. We'll take a look at Walgreens Boots Alliance, 6. All right, so it's hard to argue, at least for some it would be, to say that the stock is highly priced or expensive, if you will, or the price of the stock to what it earns, right? So again, it's not one of the high-flying growth stocks that sometimes we'll see trade at 50 PEs, or maybe even more than that. So that's kind of an interesting consideration. Now, we're going to start off at the top, time and price. Time, we're going to use the options that expire this week since the earnings are Thursday before the opening. And price, well, what does a trader think the stock might do? Now, on that chart, we saw the stock has been trading for a year in a range, and now it's sort of at the closer to the lower end of that range, 47. It's 47.8 right now. That lower end of the range is 45, 46. The upper end 54, 55. So maybe what we'll do is incorporate a short put spread into this earnings announcement. being that it is sort of at the lower end. And I just want to take a quick look with the stock at 47.48. What is the expected move? It's a little over $2. So if that were the case, they'd be looking for the stock to get down to maybe 47.5, somewhere right around that. I'm sorry, 45.5, somewhere right around that range. So let me go down there to 45.5, and that's a probability of in the money of about 22, 23%, right? So that means that the probability is that a high probability that it won't go below that. There's an approximately 78% chance that it won't. And like Ben said, that doesn't mean it can't. It certainly could, but the probability is that it won't in the next 3 days. So if a trader was looking to sell maybe the 45.5, 44.5 put spread, what would be the credit? Well, let's walk through that together and see what that comes up. So I'm going to sell the 45.5 put, hold down my control key, buy the 44.5 put, and see what that comes with. Hold on a second. I'm going to delete that and start that process over. Sell the 44.5. There we go. They're selling the put. Now, buying the 43.5. There we go. And that does not give much of a particular credit. Now, here's the thing. I'm looking at the bid ask. Are they pretty tight on this? Yeah, it looks like they are. 8 cents to 10 cents, 16 to 18. So it just doesn't look like there's a lot of value right now in those particular options. I'm going to go to the Theo price and hit reset just to make sure we are looking at the correct theoretical values. 17 and 9. Yeah, it doesn't look like a trader's going to get a lot for that. Now, what if one were to bump up to maybe, let's say, the 46 level and sell the 46.45? All right, well, let's start off by selling the 46 put and holding down my control key, buying the 45, and see if that isn't a little bit better. Okay, that's a little bit, obviously, 21 cents. So obviously, just by moving a half of a dollar, it looks like it changed the credit significantly. And again, this is something that's not unusual, particularly when we're looking at after the close pricing here to determine these values. But tell you what, let's go ahead and leave it in the 46.45 for this example trade, and I'll hit confirm and send. Let's take a look at the max loss, max gain. Max profit would of course be the 21 cents times 100. That's $21. That's the multiplier for the stock. That would be the max gain. And since it's a $1 spread, that would leave a 79-cent risk to the downside. So $21 potential max gain, $79 potential max loss, and of course we have to factor in any transaction costs there. All right, let me go ahead and send that one out, let it work in the marketplace, and we'll keep an eye on that, see if it doesn't get filled tomorrow, assuming the market's open, of course, and under normal circumstances, and then we'll look for those earnings Thursday. Don't forget, on Friday, we'll review all of the example trades for the week. All right, stay with us because we're going to take a short break, but come back with Ken Rose and talk about a very important concept to long-term investors. That's yields, returns, and the Rule of 72. We'll be back after this short break.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. we deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Your First Trade. I'm Scott Connor. Now let's turn our attention to long-term investing. Now today we'll review several essential concepts for long-term investors. Now you'll learn about the concept of yield, rates of return, and of course compounding. And in addition, you'll learn to better understand the rule of 72, which helps investors estimate the time required for a portfolio to double its value based on returns. Now, joining me to break down return rates and compounding is Your First Trade contributor, Ken Rose. Ken, thanks for joining us on Your First Trade. And I figure this is an important concept for all investors. And of course, this is the way that they often monitor how their portfolios are doing. So obviously understanding the concepts of returns, yields, and et cetera, very important. So Ken, why don't we kick it off with giving our viewers just a quick definition of what do we mean by annual return rate?
You bet, Scott. Well, annual return rate would be an excellent starting point with regards to this discussion. It is calculated by taking the total profit or loss at the end of the year and dividing it by the initial investment at the beginning of the year. This can be referred to as yearly rate of return, Scott.
Okay, so again, that's the typical sort of measuring metric that people use to at the end of the year see how their portfolio did. And you mentioned gain or loss. It's not it's not always gains, right? But again, that makes perfect sense. So you look at that total at the beginning of the year, end of the year, and then use the gains or loss to determine that. So maybe let's give our viewers just a quick example. Let's say someone had 100,000 in an account and they got like a 2% return. Maybe walk us through how they'd calculate that, Ken.
Sure. You bet, Scott. So in this example, if a depositor started with $100,000 in perhaps a savings account, and at the end of the year had $102,000, this would be a gain of $2,000. Dividing the $100,000 by the $2,000 gain gives you a 2% annual rate of return. Pretty simple, right, Scott?
Yeah, that is. So we're just assuming someone had $100,000 in a savings account. And of course, they didn't spend anything, and they were getting interest. And I remember those, in our example, people used to get interest on savings deposits. That might be coming back here with interest rates going higher. But I see exactly how that works. So they had a 2%, 102 at the end of the year, and then do the division. There you have 2% return. Now, that's for a savings account. Let's talk about annual returns and stocks, Ken.
Sure, you bet. So if we're talking about stock, we would basically start with the portfolio's value at the market close of the last day of the previous year. That's usually going to be December 31st. We then calculate the change in value to that same date a year later. This would represent the annual gain or loss on that portfolio. We then divide by the year ago value we then divide by the year ago value by the annual gain or loss to find the annual return or loss on that particular portfolio, Scott.
Okay, that makes sense, Ken. So it's a little different than just cash in a savings account. You have to get the annual, the value of the portfolio with all of its stocks, and then again measure on December 31st the following year. Okay, that makes sense. And there's a lot more that goes into a potential portfolio. I mean, stocks could be going up and down in value. Hopefully, for an investor, they're appreciating. That's something they want to keep in mind in those kinds of returns. Now, historically, if we look at annual returns for like the S&P 500, Ken, I think it's somewhere in like the 7 or 8% level. Now, not every year is that way. Some years are much higher and some are actually losses. But I think historically, the long term is sort of a rate of return somewhere around there. Ken, what we haven't talked about is dividends, right? Because stocks can appreciate or depreciate, but how do we factor in dividends?
Right, Scott, and dividends are a very important factor. What we looked at our previous example is sometimes referred to as a nominal rate of return. For a stock, dividends must be included to calculate an overall yearly rate of return. Currently, the annual dividend yield for an average S&P 500 stock is currently out at about 1.2%. we could actually add that 1.2% to the 2% to get an overall yearly rate of return with regards to a portfolio and including dividends as well.
Right. So dividends on average about 1.2% a year. And that's important, I think, because a lot of people don't know, Ken, that when a stock pays a dividend, that the stock price goes down by the amount of the dividend, right? So by the end of the year, if you're looking at your stock price, it has moved with that dividend distribution throughout the year, right? So the stock, if you want to reflect just from the price of the stock, well, it won't be showing the dividend. Like you said, add that dividend yield back in to get the annual rate of return. That makes sense. Now, there's another concept, very important, I think, for long-term investors, and that's compounding. So, Ken, can you break that down for us?
Sure, you bet, Scott. So, and it's a good thing to take a look at compounding, particularly because this moves us closer to the rule of 72. Let's go back to our 100K deposit example and assume the interest rate remains at 2% and no money is withdrawn. The first year, the account makes 2% on the 100K, but the second year, the account makes 2% on 102K. Essentially, it continues to make interest on a growing balance. So compounding interest is calculated on the initial principal plus the accumulated interest payments that have occurred in the account, Scott.
Okay, so that's an important takeaway. So for our original example of the $100,000 in cash in a savings account, the first year it makes 2% on 100,000, second year 2% on 102,000, and then et cetera, and it just keeps growing by that. So again, that's very important, that compounding, because each year that interest rate, again, we're keeping it fixed at 2%. It's on a larger amount, so very important. Now you mentioned this is good to know going into the rule of 72. So Ken, let's talk about what the rule of 72 and how that helps investors kind of make a quick estimate of how quickly a portfolio might double depending on the rates of return.
Sure, you bet, Scott. And, the rule of 72 is an easy way to calculate or estimate how many years an investment needs to double its original value, assuming a constant rate of return. It's real simple. You simply divide 72 by the rate of return to obtain a rough estimate of the number of years it will take for the investment to duplicate its original value, Scott.
Okay, that's pretty important then. All right, so let's figure this one out. Ken, let's go back to our original example of the investor who had $100,000 and 2% return. Now, and we're going to keep that 2% constant going forward, all right? Ken, according to the rule of 72, so it takes 72 divided by 2, the rate of return, and that gives me the number of years to double that account. Because we have to keep in mind the concept of compounding you were talking about. So 72 divided by, that's 36 years, Ken, to double that $100,000 account based on a constant 2% return. That's quite a while, Ken. Not sure I'd be around to see that work out, but all right. So I think what jumps to my mind, I'm sure many of our viewers can, is that by just slightly changing a rate of return, it can significantly change the amount of time it takes to double. So in other words, let's go from 2%, let's add an extra 6% and take it to, how about 8%? All right, well, 72 divided by 8, that's 9, right? 9 times that, if I'm doing my math right. That's quite a bit different than 36 years. It drops it all the way to 9 years. So you can see how just a small change in return can significantly change the amount of time. Ken, am I on track there?
Yeah, Scott. In fact, at the beginning of our discussion here today, you mentioned that the average return on the S&P 500 going back so many years has been somewhere in the neighborhood of about 8 to 9%. So that would indicate that usually, if you're looking at investing in the S&P 500, you're usually looking at about a 10-year window in order to double your investment. On average, of course, we know that what's happened in the past isn't always indicative of what could occur in the future.
All right, Ken, well, we're going to have to wrap it up there, but I think there were some great takeaways here for long-term investors who might not have thought about it in these terms of return, how important it is, and how it affects the potential of a portfolio to double over time. Ken, we got to call it there. Thanks again. Always enjoy having you on Your First Trade. I look forward to having you back as well. Thanks, Ken.
Thanks, Scott.
All right, stay with us because we're going to return after a short break, and I will wrap up what happened on the markets today. Stay with us. We'll be back after the short break.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Welcome back to Your First Trade. I'm Scott Connor. Now it's time for the wrap. Take a look at what happened in the markets on this Tuesday, March 29th. Well, markets opened higher and gapped higher, I should say, and then held on to those gains into the close. We had all four indices finish higher today with some good strength. Now, overnight, we saw some good gains in Europe, 3% in France and Germany, and the U.S. followed through. As you can see, most of the indices up between 1 and 2.5%, and you can see most of the strength was in the Russell today, up over 2.5% on the day. So, good day on Wall Street as we continue, or 2 weeks of rallying from the lows. It seems as though the momentum is still in place. Now, let's talk a little bit about some of the commodities we've been watching in addition to the stocks themselves, and start with the very top on oil, because this is one that has been just fanning the flames of inflation. We saw it go up to 130 at one point, rally up to 115 again after a sell-off to 95, and today we saw it actually drop briefly below 100, but closed at about 105. Still, it was down about 0.5% on the day. Gold also down on the day, about $20 to the 1924 level. Now, what about yield? Well, we saw the 10-year yield drop just a little bit lower. It's down to 2.4%. Remember, just recently we saw it up to 2.50. Remember, when you're looking at this number, move that decimal place one to the left. 2.4% is currently where it's trading. Now, what about Bitcoin? This is one we've been watching. Had a big move yesterday to the upside, broke through the 48,000 after 3 attempts all year long to get above 45,000, and many were thinking this could be the breakout. Just flatlined today. Really didn't do much. Actually was down slightly. So we'll see if some of that risk-on appetite is still there. And finally, the VIX, or the fear index, broke below 19. We haven't seen that for a while, since early January. It closed at 1892, but was down as low as 1867 during the day. Now, what about some stocks and sectors on the move? Well, let's start off with some of the FANG stocks. They were strong today, and that includes the tech sector, consumer discretionary, communication services. Some of the big names in that group include Microsoft, Apple, Meta Platform, which is, of course, the parent of Facebook. We saw MasterCard also showing some strength today, along with Tesla. All of these stocks showing gains in those FANGM sectors. So some good strength there. Particularly, take a look at MasterCard today, up almost 5% on the day. Tesla also up about 1% after having been up, I think, 10 out of the last 11 days. Now, where do we see a little bit of weakness? Well, there really was only one sector that was down on the day, and that was energy. We did see oil drop lower, so some of the names in energy were down as well. Some of the big names, kind of interesting a split though. We had Exxon and Chevron down, but some of the explorers, as you can see with Schlumberger and Halliburton, showed some strength today. So kind of mixed within in the energy sector itself. All right, now let's talk about some individual stocks. Well, we saw Ford had a nice rebound today. Auto stocks showing some good strength based on what's happening in Ukraine with some of the negotiations and electric vehicle sales. We saw some good numbers from reservations in GM. What was on the downside? Well, Deere, symbol DE. That stock was a little bit heavy today as it moved lower in a stock-related story. All right, now, outside of Deere, let's take a quick look at some of the economic data that may have been impacting markets today, starting off with consumer confidence. Now, this was for the month of March, so this is a recent number. There was a little bit of fear this number would be much lower than expected. However, it did come in just slightly better than what was expected. So no big letdown for the March consumer confidence. We also got the Jolts number. Jolts, Job Openings and Labor Turnover Survey. This is a number that tells us how many job openings there are out there. Now, we thought it would be a little bit less than 11 million. It actually came out 11.26 million. So the number of open jobs seems to be stubbornly holding on to higher levels. We'll keep an eye on that going forward as well. But overall, good takeaways from the market again today. All four indices up. We're up 2 weeks in a row now. We seem to be holding on to those gains. We'll watch closely as the week progresses. All right, that's going to do it for our market wrap here on this Tuesday, March 29th. We look forward to seeing you tomorrow at 4:30 Eastern Time right here on Your First Trade.
market here has rallied back. Tesla's done really well compared today, just getting back up above 15,000, just getting back to those Feb highs over the last couple days. But take a look here as Tesla, well, they took out the Feb highs basically a week ago. I mean, again, you can see the run up here. Here's the Feb highs up around this 950 level. And so they have been off to the races, continuing up and through the $1,100 level. So just shy of that right now, currently trading up on the day by 0.25%. Now, we've seen some other big tech names, Amazon, Apple. I think you mentioned Amazon, Nicole, but Apple also on the move again. They're seeing the best week. I think it is best winning week since 2003, but a nice run up here. And I do want to point out, again, if you take a look at the daily time frame, you'll see, again, the net change here. Again, year to date, we're talking only up by about 3.5%. But look at month to date here, up 25%. You can see the big move that we've seen back off this $800 level. That gets us through the 50-day, the 200-day moving average. It looks like we may be able to avoid a death cross here, which investors were concerned about. Now, you can see that the RSI is a little bit overextended at this point. You can also see a couple of the hurdles that we still have to get up above. We'll just call it a double top-ish area that we have around that 1,240 level. I wanted to look at the weekly because I wanted to point out this is exactly what the Boeing bulls are looking for. Remember, we were talking about how Boeing is kind of in this a bit of a channel to the downside right now. Well, again, in a very similar pattern in many ways, how if Boeing bulls could get some energy to the upside in terms of what we're seeing with Tesla, well, this is a very bullish pattern here. We oftentimes talk about these ranges that form through the middle. In this case, we'll call it 1,000. Oftentimes opened up the door for a retest of the upper extreme. So, yeah, there's some momentum going here right now. Again, the one thing that has me a little concerned is the RSI is a bit overextended here, Nicole. But, again, that's on a daily time frame, I think, one thing to take note of. And for two, a reminder that it can stay that way for a prolonged period of time. And there has been some strength there, to say the least, yes.
Final thoughts, Achilles, on Tesla as Ben summed that up?
Yeah, remember, we're going to be going in 3 different times, 3 different trades. So we're definitely going to average our costs inward. But once again, owning a high-quality stock, brand-known name, an innovator in its space, we believe that you're going to do well with this trade.
Yeah. Okay, let's turn our attention to Coinbase. Obviously, we've seen Bitcoin pull back, even though it's run up a little bit recently. Coinbase, much of the same in that it's well off its 52-week highs. Achilles, do you see opportunity now for Coinbase?
Of course, Nicole. When you see a stock getting beat up along with cryptocurrencies, this stock does pretty much what cryptocurrencies do. So crypto has been in a bear pattern for a long period of time, but also coming out of it in a very quick manner. So Coinbase doesn't really have any buildings or any assets per se on the big side. A lot of their model is remote and the like. This is where we see the opportunity. When we start to see the run up in cryptos, this stock goes up accordingly. It's up almost, I believe, 16% just in the last 2 months and a half. And we see it going up further because it has been tested quite a bit during that time period. So just going forward, another name to own. This is one where you really have to be cognizant that you're not going to own this for a long period of time. You're going to own this for maybe a 12-month period, in my opinion, maybe less. But we see a definite pattern on the upside, a definite pattern for making money for that short frame time period.
Interesting. It's not too often that you come on and say for 12 months or maybe less. Ben, what do you think when you take a look at this Coinbase chart?
Well, I think that's actually kind of important because relative to Bitcoin, although, again, we've seen coin get a bit of a lift with that appetite for crypto coming back into play, that kind of risk-on, cautious optimism, I guess I've been calling it, again, over the last week or two now since we've come off those March lows. Again, we were just talking about the indices and the tech names that have rallied back. But, you know, this is one that's been lagging a little bit relative to Bitcoin. Again, Bitcoin actually broke out of a range back to January levels, mid-January levels yesterday. But here you can see, again, coin is lagging a little bit relative to. So I want to point out that, well, maybe Achilles is right here in terms of the potential for a short-term lift if we were to get some follow-through as far as Bitcoin. But Nicole, you mentioned Bitcoin's having a hard time kind of seeing some follow-through today, which is a little bit concerning considering, well, the broader market here is getting a little bit of a bid. But Still, again, a ways to go before I can get really excited about this one. Possibly a bottoms in here, but I want to see some of these areas that were established on the way down get taken out. For example, first and foremost, the Feb highs ultimately, and then, as mentioned here, back to, well, as Bitcoin's been able to get back to the mid-Jan levels, I'd like to see coin do so as well. I don't need to be the first one to buy the lows here necessarily. I'd like to see some momentum to the upside, but you can see here, speaking of momentum, there has been a little bit in terms of back above the 50-day moving average. The RSI has some room to expand here. One thing that's encouraging for the bulls, look at volume. It's really increased over the last recent levels. But I do want to point out, I've got my eye on this 220 level. Again, I think it's going to be important. Here we are right here, the upper extreme of this range that we've been in basically since the gap down that we saw, if you remember, back at the end of January, middle to end of January. Take a look at the weekly time frame. You can see again here, really this is that 220 level. So you can see the big move down. And since then, we kind of been a little bit more rotational after bottoming out around 150. So I think that's the next hurdle to get up above here, this 220 level. And then could be some potential to the upside. Also take note that 220 level coincides with the lows that we saw May, June, July, and through the early fall of last year. So prior to kind of failing up around 360 after an attempt to break out, you can see that really well-defined series of lower lows and lower highs on a weekly basis all the way down to 150. So again, I think 220, the next hurdle, 150, the level to the downside that the bulls want to be a bit concerned about. Should we take that out?
I'm glad you did the upside and the downside, especially with that 220 on top, considering that we've seen Coinbase down 21% at this point. So that's a good point to make there, Ben. Thank you for that. And thank you both, Achilles Larea and Ben Lichtenstein, for today's big three, Boeing, Tesla, and Coinbase. Appreciate it. Coming up next, Dan Ives is standing by of Wedbush. He's talking about some of these hot stocks, Tesla and Apple, both making news. Both have been running higher. He has all the details and much more next here on Trading 360.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watchlist, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. Let's take a quick look at the markets. We're looking at the Dow at 239 points at 35,194. The S&P up 0.75%. The Nasdaq gaining 1 full percentage point at 15,140. And the Russell is gaining 2% as we speak. We have a very special guest with us right now, and it is time for our spotlight. We're spotlighting Tesla and Apple, two names that have been on the run. Dan Ives, Managing Director, Equity Research at Wedbush Securities. Of course, all about his Tar Heels. We'll have much to discuss, Dan Ives. Let's start with, I mean, you've loved these names. You've touted these positively based on the fundamentals and your channel checks. Let's start with Tesla. So is this the right time for shareholders to issue more shares so they could do this stock split and move forward? Tell me your thoughts on the big Tesla talk now.
Yeah, and look, I mean, this is obviously the second stock split in as many years. I think it just shows, just how strong they've actually gotten in terms of demand. As demand continues to play out on EVs, this stock, in our opinion, is going to continue to move higher. You look at Giga Berlin, you look at Austin, supply was the issue. That's no longer an issue. And Nicole, in my opinion, this is really just the start of this next leg of the Tesla story.
And what do all the contrarians say that you think is absolutely out of line when they talk about Tesla? I mean, that just gets under your skin, and you say they really just are not as informed when it comes to Tesla. Is it Elon Musk's leadership? Is it what else Tesla does besides the way they're able to produce the vehicles and keep their promises? What is it that you would say to some of those folks that are really on the downside of Tesla?
Yeah, look, I mean, I would say if you've hated a stock at $100, and now split adjusted, you hated it at 5,000. I mean, I'm sure, again, if these were NFL scouts, they would have hated Tom Brady coming out of Michigan in the 2000 draft, right? So it just, look, I think it just comes down to haters will hate. But if you look at what's happening in EVs, you look at how they're building out in Berlin and Austin, you look at overall demand, they could be looking 1.6, 1.7 million units this year. Going into next year, we could be looking at 2.5 million. So as this all starts to play out, I think it's a re-rating story, but also it's because of profitability. I mean, now they're starting to really ram profitability. And as a risk on starts to take hold, Tesla is going to be front and center.
As we look, and I see so many of the other names are higher, right, in the group overall. But I think so much of it, and you tell me, is Elon Musk. And my worry one day is that he puts out on Twitter, Tesla's doing great. I'm going to focus more on my rockets or whatever else is his next baby. And what happens to Tesla shareholders? Don't you ever, I mean, because I know we have some issues now that may be some headwinds, such as in Shanghai, the shutdown of the plant. We've had supply chain issues, which hasn't really affected Tesla as much. But is there anything that could be some major headwind that could be realistic?
Yeah, well, first of all, I don't see Musk leaving as CEO probably till at least second part of the decade. So I don't think that's something that's really a risk in the next 4 to 5 years, especially as FSD starts to continue to ramp. I mean, look, the biggest headwind is, of course, China shutdowns, a zero COVID policy that could strain supply if that continues. But outside that, we don't really worry about too much, fundamentally speaking, as it plays out.
Mm-hmm. All right. How about we turn our attention to Apple at this point? Both these names have been driving higher, as you said they would. You've liked these companies for a long time, the leadership, the moat, the products, the brand loyalty, all kinds of things. Slowing down on production. Is this a big deal or not a big deal?
Yeah, it's not a big deal because that continues to be tangential in terms of iPhone SE. iPhone 13 is really going to be front and center. Demand continues to expand. I think as that plays out along with services, it's a re-rating story. And in my opinion, this is a stock that continues to move higher.
As we saw Coda winning over at the Oscars, how much is the streaming side of this going to become a story? Because really, Apple TV really didn't feel like a major competitor, did it? I mean, like we saw Disney come on and get all these subscriptions, and there's so much other talk. Apple TV wasn't really front and center. How about now?
I think that, look, I mean, it's historic, right? I mean, for a streaming player to win Best Picture, and it's not Netflix or Amazon,
Right.
it's Apple. I think it really shows that they're no longer tangential. They're going to further ramp up their content efforts. I think they could double down there. I think it's worth $10 to $12 incremental to the stock as it plays out. And, I think it just shows less than 3 years within launching Apple TV Plus, they win Best Picture for Coda, which is just a groundbreaking film. And, even though, of course, the Fight Club scene was front and center at Academy Awards, I think actually the headline was Apple winning Best Picture as a streaming player.
I like how you summarize that. Well done, well done. And yeah, I think Coda was very impressive, and I think that's why it was an incredible takeaway for so many reasons. That being said, I wanted to know your targets, what your base case and your bull case are for these names for both Tesla and Apple. We always check in with you on that.
Of course. Yeah, so 200 base for Apple. I think we'll see north of $3 trillion again as a market cap. 225's bull case. And then you look at Tesla, 1,400 base, 1,800 bull case. Look, I think as we start to see this sort of risk-on trade play out, Apple's going to lead us higher across the board in tech, and that's why we're bullish here. And to me, it's a time to double down on an oversold tech tape.
I think people get obsessed with a name like Tesla because it gets so exciting, right? And when they see it down at 600-700, they say, oh my goodness, and it was 1,000 and it was more than 1,000, and they jump in and they think there's some big buy happening. And it's true because it gets back above 1,000 in the blink of an eye. And now you have the talk of this stock split. I mean, what's the timing? How fast do you expect this stock split would happen?
Yeah, but Nicole, they said the same thing about Tar Heels in late January, that they wouldn't make the tournament, and now they're in the Final Four. So the point is, I think being very near-term focused, I think the stock split just another positive catalyst as this all plays out. Fundamentally, we'll have deliveries next week. We're expecting bullishness there. And then you got the barbecue in Austin, the ramp of Berlin. That's going to be the key as they further flex those muscles on EVs.
Okay, and for your Tar Heels, I know what you're doing on Saturday. You're having this big rematch, right? Because Coach K was crying after the last game, and you want to just do it again and blow them out. Is that what you're hoping for? I mean, the Duke fans are probably not happy with you right now.
Look, but just an amazing run by Duke and Coach K, of course, the legend, the GOAT, to get there. Carolina, just a massive opportunity and what they've done in the tournament. But I think on Saturday night, this ultimately ends with Duke leaving New Orleans and Carolina going to the final. And I ultimately believe we're in the championship.
Oh, I like it. I like the predictions there. It's so great to see you, Dan. Thank you so much.
Great to see
you.
you.
Were here on the floor of the stock exchange. You could talk. Oh, thank you. Thanks, Dan Ives. I mean, all the traders here would love to talk March Madness with you. You know that, right? They love this. It's good to see you. Thanks, Dan Ives of Wedbush. Thanks. Coming up next, we're ready to talk about the disruptors. We're looking at Fortinet. Barclays upgrading this stock, and George Silas has all the details and a way to trade it.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York City. It's time for the Disruptors, and George Sillis is here. He's back. Welcome back, George. Looking at Fortinet, FTNT, what a nice run it's had recently, and Barclays upgrading this stock to overweight. Tell us a little bit about this one.
Yeah, it's actually been a good runner in the cybersecurity space, Nicole, over the last year or so. Fortinet's up about 85%, and even the last 6 months compared to some of the peers. Companies like Okta, which actually are, again, cybersecurity names, but that company actually faced a cybersecurity breach, so that actually is a challenge to their business. But over the last 6 months, Fortinet is also up 18%. But it's really a traditional network security company. One of the things about it, it's got a really good balance between products and support services. Product revenue is about 35% of its revenue, and about 65% is services. And the services component of its business is a higher margin area of the cybersecurity space, but they focus on small and medium-sized businesses, government agencies, and today we get an upgrade, a really modest one, if you will, by Barclays. They upped the stock to an overweight from equal weight to 395, and this is their next 4-quarter target from 364, and they actually see a continuation of the solid foundations of fundamentals. And if you look at Fortinet, there's a reason why it's been higher in the last year compared to other higher growth but lower multiple or lower profitability names like CrowdStrike. The free cash flow margin is about 49% for Fortinet. It's got a GAAP profitability about 18%, and that's again compared to CrowdStrike, which actually is not profitable at all on a GAAP basis. So this is really a demonstrative of the market we're in. There is growth in technology names, especially these names like Fortinet, which are still growing 30+% revenue year over year, but it's growing profitable, and it's also growing with a very high free cash flow margin. And that's why Wall Street has rewarded companies like Fortinet relative to some of these non-profitable and highly priced to sales-based companies like CrowdStrike, as well as Okta, which again isn't necessarily profitable on a GAAP basis, but also they face some challenges of recent based upon a cybersecurity breach of their own product.
Yeah, as we look at all these cloud names, right, and the whole group overall, tell me, when you compare it to the peers and you have an example trade, it's already had this nice run that you and I were speaking of. Tell me the big picture here going forward.
Well, so going forward, there may be a potential for some of the growthier areas of the industry group. Maybe CrowdStrike, maybe Okta will recover a little bit quicker. I don't necessarily think Fortinet is going to, move quite a bit aggressively higher. Again, if you just look at the price target relative to the current price of $340, that's a pretty modest increase of about $65, which is close to 20% over the next year, which is pretty reasonable considering we're in a nice rebound in the market and the cybersecurity space is growing, especially the cloud area of the cybersecurity base, where Fortinet is actually more of a hybrid. They've got on-premise traditional networking, but also cloud, which is growing. And with that said, if you just look at the stock, it's been relatively range-bound, somewhere between 260 and about 390. And in the last 3 to 6 months or so, within that range, I don't necessarily think it's going to break out of that within the next 3 to 6 months. It could reach the higher end of that range, which is the target that Barclays has got around 395. But between now and then, let's look at, for instance, April, about 52 days to expiration. We could certainly sell a combo strategy here, which is an iron condor, by looking at selling a 390, 400 call spread, and then below the current price, selling a 290, 280. So we're basically getting very wide ranges here. Break evens on this would be 390, 280 on the upside, 287.20 on the downside. So if you think it's going to stay within those two break-even ranges, you could sell this, or a trader could sell this particular strategy or combo for about $280 a contract. Now, that's your reward. Your risk is, of course, the other side of that, which is about $7.20, but your return on risk on this trade is close to 40% at 39%. And that's what you want to do when putting on a combo trade like this. You want to see your return on risk greater than 30%, as well as having some probabilities of expiring within those two boundary ranges of 390 and 290 between now and expiration.
Right. Got it. Thank you so much, George Sillis. Great to see you looking there at Fortinet for us today, which had an upgrade and now an example trade as well. Thank you, George Sillis. Good to see you. You notice we're live at the New York Stock Exchange. Doesn't it look cool? It's so great to be here.
Looks fantastic.
I have to tell you. It's fantastic, and we have now our finger on the pulse. We put our footprint here, George. We're ready to really make our mark. Thank you. Coming up next, we are going to preview Chewy's earnings in our 360 round. The online pet care company. We're going to take a look at this, and as people get back to the stores, what does it mean? Our panel is next.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust the time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Yeah,
away.
wow, I
gotta
take off. Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. They're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Commodities are lower after a top Russian negotiator, Vladimir Medinsky, said ongoing talks with Ukraine have been constructive. Crude oil down around 3%. The WTI sold off on the news, back below 100 to $98.44. The Brent down to 102. Medinsky said he would look at the Ukrainian proposals, report on them to Putin, and that a Putin-Zelensky meeting is a possibility. Grains also lower. Corn briefly limit down. Beans are lower by around 1.25%. Wheat and corn are both down by around 3.5%. Now, while commodities are lower, the indices, the ES, the NASDAQ, the Dow, and the Russell are getting a lift. The NASDAQ's up around 1% and back above 15,000. The Russell up and through 2,100 as investors exhibit what could be best described as cautious optimism, with the take on talks from the Ukrainian side a bit more outcome focused. Top Ukrainian negotiators said there needs to be a full peace across Ukrainian territory for any final agreement with Russia to come into force. And while the promise of less aggression and less military action in the days to come is encouraging, many are asking for a 48-hour ceasefire. And without one, and rates here in the U.S. at elevated levels, the fundamentals that have us pulling back off the all-time highs from earlier this year still remain. The TNX 10-year yields at 2.4%. The TYX, that's the 30, still above 2.5%. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Petalides.
Welcome back to Trading 360 live from the floor of the New York Stock Exchange. I'm Nicole Petalides. It's time for our preview of Chewy. Chewy will report its earnings after the bell today, and we have our panel ready. Seth Basham, Managing Director, Equity Research at Wedbush Securities, and Lee Bowles, Senior Manager of Trader Education at Charles Schwab. Thank you both for being with us. Seth, I saw you have a neutral on this one. What is it that you're waiting to hear? I know they've had some slower growth, some headwinds, so not a great buy. Why is that?
Yeah, there are two factors that leave us neutral in this name. One is slower growth, especially in net customer additions, and then secondly is their margin outlook. We see margins remaining under pressure as the company grapples with inflation, not just in product costs, but also in shipping cost inflation. That puts them at a cost disadvantage relative to bricks and mortar peers.
And that's something you were talking about, Lee. You were talking about some of the headwinds of costs, right?
Yeah, yes, indeed. As Seth said, cost for transportation, but also labor. They've had a bit of a problem filling some higher paying roles, but I guess they have done a little bit better with that. Also, they have their supply chain challenges. And of course, one other thing is, we had this big pet adoption during the pandemic. So people bought a lot of pet supplies, but yeah, they still sell food, but there's a lot of bowls and leashes and everything that people have already bought. You don't buy them all the time. So that might be another headwind there.
Right, and that's something that was in your notes, Seth, actually. The rate of pet adoption actually slowing in the fourth quarter was something that you noted, Seth, within your notes.
Right.
And also just some of the headwinds that they've been facing. I mean, is there a lot of competitors? You talked about inflationary pressures, but also some competition too, right, from the likes of Target and Walmart?
Yeah, for sure. I'm sorry, go ahead.
No, Seth, go ahead.
As it relates to the competitive environment, we are seeing a little bit more competition from the likes of Target and Walmart. They've been slower to pass through some of the product cost inflation, which has limited the ability for Chewy to maintain its gross margin rates. And we think that Petco really has hit the nail on the head with its business model, which is really end-to-end holistic pet care, which cannot be provided fully online in Chewy's model. So they're taking material market share as well. As it relates to the outlook from a margin standpoint and a pet adoption standpoint, first on the margins, we're expecting declines in the first quarter and 2022. And as it relates to new pets, we're expecting normalization of pet adoptions. That started to occur through 2021, and I think we'll be back to a normal rate in 2022, which will slow the top line growth for the entire industry from extreme levels back to more normal levels, with the caveat that we still get an annuity stream from the installed base of pets that were acquired during the pandemic and still will continue to eat and eat more as they grow.
Right. So, Lee, what do you think of the chart?
Right. The chart is saying wait, I think. Just a couple of key levels you might want to look at here. We have some support there at 35.80. You can see that's the short-term triple bottom support level. And I think traders would want to see that high taken out of the 38, that's 55 up there. That's the high of the triple bottom. We also see we have a trend line, though, that we broke, but we've got now the 50-day moving average just right below it, but the 100-day right above it. So it's you've got some work you've got to definitely do here. The only thing I would say is that this is a very kind of arcane point, but that last bottom you see in the triple bottom there, that particular low was actually inside the lower Bollinger Band, and the previous low was outside. Sometimes that solidifies that area as a very strong support area. So also keep your eye on that. But it's
that's a good point. I like that. Seth, what would it take for you to change from a neutral to a buy?
Yeah, so, and this is a really tricky print for one, because there is very high short interest and relatively low expectations. There are good industry fundamentals as reported by Wolf, that is Petco. That being said, we think the company Chewy is at a bit of a disadvantage in the near-term environment because of the customer ads as well as the gross margin outlook. So if we see better customer additions than forecast and better gross margin guidance than forecast, we very well could change our view.
Right, I understand. Okay, and I mean, obviously the labor costs hopefully will be coming down some. Lee, you noted some of the headwinds, but customer loyalty is important. Final quick thought, Lee.
Right, so I think some people like the company because it is one of the few pure e-commerce plays, so it does have that going for it. But as Seth said, even if the dogs are eating more, there's a lot of people that sell dog food.
It's great to see you both. Thank you. A great setup for today for Chewy after the bell, which of course we'll have here for you folks. Thank you both. Seth Basham of Wedbush and Lee Bohl of Charles Schwab. Thank you for being with us. And that is going to do it for Trading 360 live on the floor of the New York Stock Exchange. Thanks for being with us. I'm Nicole Petalides. I will see you at 2 p.m. Eastern Time for the Watch List. Fast Market is next.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow. So what are you working on?
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
Wasted time is wasted opportunity.
Exactly.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. See, you just...
Oh, this is easy.
Yeah, and that's...
Oh, just what I need. Courses on options trading, webcasts, tutorials.
Yeah, their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Oh, exactly. Well, except now you're binge learning.
Ooh, I like that.
Thank you. I just came up with that.
You're funny.
Learn fast with the TD Ameritrade Education Center. Call 866-300-9417 or visit tdameritrade.com/learn. Get started today, and for a limited time, get up to $800 when you open and fund an account. That's 866-300-9417 or tdameritrade.com/learn.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
will give us some color in terms of how and inflation have been affecting basically either their margins, their corporate margins, or the health of the consumer. So, the bullish thesis here, Tom, is hey, look at the employment numbers, look at corporate earnings, look at a lot of the economic data, expansionary territory. A lot of that has come from the Fed and from fiscal stimulus, and it's the Fed is raising rates, but it's because the economy is strong. It's because the consumer has excess cash. It's because they believe the consumer is going to hang in there. So that's really the thesis for the bulls, is that rates are going up for the right reason. But yeah, this earnings quarter is going to be so critical in terms of getting that clarity from those companies that are closest to the ground in terms of how the consumer is actually behaving, and guidance being obviously key within that component as well. And then you look at the price to earnings ratio on the market. I'm still kind of surprised we're a little bit this high with the yields creeping up as they have been. So we got to keep an eye. 2.5% looks like where we had some buyers come in on the 10-year. But if that continues to go up, that tends to be kind of detrimental for that valuation aspect around 19 or so on the S&P right now, which is historically high.
Yeah, and you mentioned that S&P 500 just above those failures in February at those highs right here. So is this a breakout, or do we get some follow through maybe to the downside, maybe some consolidation here? We'll have to wait and see on that. But one area that's doing well today, but Goldman Sachs came out with some notes on the consumer staple sector, Nick, and they're giving price target cuts on Procter & Gamble, Clorox, Colgate-Palmolive, Reynolds. Some of these consumer staples and their products, right, their brands, and they're saying that this inflation caused by Russia, Ukraine now, and the already existing inflationary pressures that we've had out there as far as pricing goes, it's going to prolong it, right? And that's going to be a detriment for their margins moving forward. Your take here, because this is typically that safety area that a lot of investors look at when they want to have paid dividends. These are financially, for the most part, pretty secure firms as far as the amount of cash in their balance sheet that they're a safety play considered sometimes. But when you get a firm coming out and downgrading or cutting price targets on a lot of these stocks, does that raise red flags for you that, hey, inflation's here to stay until the end of the year?
Well, I think Nate just hit it, right? Like it's a valuation concern, and it's really about understanding the fact that these companies have the balance sheets, right? They have the fundamentals to make it through the cycle. That's not really the question. It's about how much do you want to pile in at these levels, given the backdrop of everything we're talking about. There's a war going on, right? But the inflationary concerns, now you're seeing the potential inversion of the yield curve. We haven't, we made it 19 minutes without talking about that. That might be the biggest indicator of fear down the road, right? Like the recessionary concerns that are built in right now. I was reading something this morning, I think from Bloomberg, that was saying, the U.S. is the most likely nation to experience stagflation based on economic data. So there's a lot of concern out there for that type of environment. It doesn't mean you're going to stop buying Palmolive dish soap or Dove shower gel, right? But the companies are going to really potentially have earnings contraction if the cost of labor continues on the uptrend, the cost of all of the components going into all of these consumable products is on the uptrend. It's difficult to see that scenario where that and a rising rate environment doesn't make corporate profits look a bit worse. It doesn't have to be drastically worse. And I think you're seeing that in some of these downgrades. There are still buys or still holds, but the prices are coming down a bit. And I think that's the logical backdrop right now that's out there for a lot of these companies. How could that go the other way? Well, if inflation really does come down sooner, if companies figure out their supply chain issues sooner, if this war really does wind down sooner, I think, these valuations are probably still a bit elevated, but seeing that end sooner, I think would give the markets, which tend to be forward looking, a lot more confidence in kind of the current valuations. And you might see that volatility kind of remain low.
Yep, and that 2-10-year yield curve is at the flattest level that we've seen so far over the last year, so we'll continue to watch that one. We had the inversion of the 530 yesterday. I'm looking at the 3-month 10-year, and that's still widening at this point, so no inflation or no recessionary fears there. But now let's get into a discussion about Micron. They report earnings after the close. This is one of those stocks, Nathan. It's down about 14% this year, off all-time highs that we saw at the end of last year. But this is one of those stocks that a lot of people say, oh, it's in the chip space, but it's cheap compared to NVIDIA and AMD. But this is a different segment, right? This is memory-based chips, DRAM and NAND. And you get more price fluctuations in there as far as demand goes and their margins also. Your take on here on Micron and what it's telling you into these earnings.
Right, yeah, you're exactly right on the 7 PE. You know, it really sticks out. You look at it historically, though, and that's really been the case for a stock like Micron. They really follow those price charts on DRAM and NAND, as you mentioned there. Technically, you look at the stock, it's basically just kind of in this sideways channel between 70-ish and 98-ish, kind of in the middle of that range. We are above the 200-day SMA. You know, they had a really good report last time, and they received a couple upgrades this year so far. So, you know, the semis have come back. We've seen some pretty extravagant bounces off the lows. If you look at something like an NVIDIA, for example, and how much it's recovered off that March 8th lower. So Micron, not as much. And you know, it really comes down to the pricing of their markets there for DRAM and NAND. And, you know, there's, you know, on the bullish side, they talk about the data center. On the bearish side, they talk about the PC, perhaps some coming in there. You know, to 7 PE, it's kind of hard to overlook within the chip space.
Yeah, definitely. And Nick, when you look at this stock, it's been pretty choppy over the last 3 months or so. Did hit those all-time highs at the beginning of January, about $98.50 a share. Just broke through its 200-day. Still got some resistance at its 50-day moving average coming up. But when you look at this stock going into earnings, and we see some big moves post-earnings. That doesn't mean it's going to happen again. But your thoughts here on Micron?
You know, Tom, it has bounced really nicely. You know, 65 was the low. It's certainly come back up from these levels. Sorry, I got some background noise. We finally got somebody to come and do some work at the house, which is a crazy thing these days. Can't get away from it. So apologize about that. But you know, it is a crazy bounce that we're seeing in the stock off of those lows. And I think to hopefully go into earnings and hear demand is strong and chips are coming back online, particularly that physical hardware, I think is a really important thing. So as always, when we go into these earnings calls, the numbers matter. The stock's going to move on that, but we really need to understand what the forward guidance is for these companies. And I think it's going to be fascinating to hear how they talk about their supply chain and how they're delivering on those. Because if they're not able to deliver, even if demand is there, I think that's where you can see a company like Micron get hit and kind of fall back down to those low levels that we've seen. If they're able to tell us that their forward outlook is great, hey, that's awesome. And it's all going to be about deliveries, I think, for their earnings guidance.
Yeah, definitely. And Nathan, we've got an anticipated market maker move that the option market's pricing in about $6.10 plus or minus either way. Stock's trading about 80.70. How do you want to look at this? Because if you look at the implied volatility in here, you know, the near-term month is about 113% on aggregate, and then it falls off pretty broadly over the next few option series. So give me your example trade here in Micron going into earnings.
Yeah, Tom, you know, normally when I hop on this show, and you guys as well, you know, as an option trader, when you see that IV discrepancy, that skew based on the earnings week, you kind of want to, you know, position yourself such that you can take advantage of that skew, you know, via calendar call, calendar put, long diagonal, call or put, et cetera, based on your outlook, bullish or bearish. Today, just as an example, I just wanted to throw out a strategy out there. So I'm sticking to this week's expiration, and the strategy is a call front spread. It's a ratio spread. You're basically going long one call and you're selling two at a higher strike price. It is a bullish strategy, but you can position it such that you can bring in a credit. And so I was deliberately trying to position this around that implied move of about $6. And I also wanted to position it such that you could put it on for a credit, at least at the time that I was looking at it. So what I was looking at is basically this week's 83, 87 call front spread. You're buying one of the 83s. You're selling two of the 87s. At the time that I was looking, it was about a 19-cent credit. Where does this leave you? Well, basically, if the stock tanks, 19-cent credit. If the stock goes sideways, 19-cent credit. If you get that implied move to the upside, your maximum gains at that 87 strike, you just really don't want this guy to push on above the 91 level. That's where some losses can occur since you're short double the contracts.
Right, so we've got a back ratio here where you're buying one of the April 1st weekly, the 83 strike call, just out of the money to the upside by a couple bucks, and then selling two of the 87 strike calls. Your credit's about a dime, we'll say right here. So you're still profitable on any sell-off in the stock because you did collect a credit for it, but you do have risk to the upside because you're selling two of the 87 strike calls. So it's almost like you buy the 83, 87 call vertical, but you sell an extra call to collect to that credit, because if your assumption is that it's going to go higher, but maybe just that one standard deviation move and kind of settle in there at the apex of profitability on that, where it's almost $500 in profit at that 87 strike at expiration. You break even about 91.10 on this if you collect a credit, but you do have risk all the way to the upside. So if we do get that big move to the upside, that's where the pain will come in on this type of trade. Nathan, your final thoughts on this, because what I look at when I look at a trade like this is, yes, it's a bullish trade, but it's moderately bullish, expecting the option market to kind of be pricing right the move to the upside, especially after the pullback that we've seen from those all-time highs at the beginning of the year.
Sure. Well, first I'll say is that, keep in mind, you've got a requirement on that short call. You're net short a call at the top. So there's a requirement for that. The other thing that I would say is, because this stock is in this sideways trading range, you might be inclined to feel a little bit more comfortable with a strategy like this where you're net short a call. What do I mean by that? Well, if you're in a stock that's in an uptrend and it's basically rallying into all-time highs, analysts can't get over their estimates quite enough. They keep on raising and guiding, and sometimes you get some of those outsized moves, meaning moves that are either bigger or lower than the implied move. So if you go into a situation where it's a really hot stock, really hot market, analysts keep on raising their estimates, and you were in danger of getting this above implied move, this probably wouldn't be a strategy that you would employ. But since it's been in this sideways trading range, maybe that makes you feel a little bit more comfortable that you're not going to see this stock basically spike above that 91 upper break-even level.
All right, great analysis on that example trade here in Micron, taking advantage of that anticipated market maker move here and the higher implied volatility by selling that extra call against that. Remember, you do have risk to the upside on that. All right, great stuff as always, Nathan. Thanks a lot.
Thanks, guys.
All right, that's Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. But coming up after the break, Nick and I will be joined by Megan Brantley from Likefolio for a discussion on Lululemon ahead of their earnings. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in. discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade. I'm Tom White. I'm joined by my co-host Nick Theodorakis, but let's bring in our next guest for our hashtag segment, and that's going to be Megan Brantley, the Vice President of Research at Likefolio. Welcome to the show, Megan.
Thanks for having me, guys.
All right, we're talking Lululemon. Shares are down about 11% so far this year, off nearly 30% from those all-time highs we saw last November. It seems like consumer sentiment data is getting hit. It would see in some softness as the Omicron variant was pretty rampant in January. We saw the overall market get hit, and maybe that's causing Lululemon. And what kind of data are you guys seeing into this report? Because it seems like the way that people are dressing has changed over the last couple of years since the pandemic started. But they've also got some new products coming online here too. So what's your data showing us today?
Yeah, so you guys really had to twist my arm to talk about Lululemon today. I was really thrilled whenever I saw that that was the topic. Right. But what's really interesting when we look at a company like Lulu is you're right. They did benefit as really dress codes kind of loosened up over the pandemic. You know, people were buying clothes to work from home instead of clothes to work in. And so now things are kind of shifting. But what's interesting is that somehow Lululemon is now harnessing a whole different set of trends. So when we look at mentions of people who are talking about, going to a group fitness class or joining a gym, those mentions are up by double digits year over year. So, whenever you're re-entering this public workout sphere, you need nice workout clothes now. All of a sudden, you care what you're wearing to the gym versus what you were wearing when you were working out in your basement. So it's interesting to start to see Lulu, harness some of that momentum as well. And I think this chart is really interesting because, we always talk about how are these companies performing versus peers. And, we included, Nike, Gap due to their Athleta brand, and then Under Armour just to give some perspective. And what you can see is that Lulu, at least from a demand perspective, that's that x-axis, it's gaining the most momentum versus its peers. I think that another interesting note that I want to call out is you'll see that, this is something that we've talked about, that Nike has been doing a really good job lately in terms of consumer happiness. And actually we see Nike higher than Lulu. But what's fascinating is that the reason that Lulu has kind of, lost a couple of those happiness points, especially recently, is due to this new product launch that you kind of hinted at, these new tennis shoes or running shoes that they launched that are sold out and people can't get their hands on them. So we have sold out mentions just spiking and really kind of dragging on that sentiment. So it's a little bit of an interesting scenario for Lulu to be in, but I think that, it's a positive sign, at least for our data. We're seeing Lulu kind of reach this inflection point as consumers are returning to shopping in stores again. They're getting back in the gym and they're really liking these new products that Lululemon is putting out.
It's a great analysis, Megan. I think it's so interesting to see, right, companies that figure out multiple revenue streams, right? They bought Mirror too. We didn't even talk about Mirror, right? They've got at-home fitness. It's okay to wear their pants if you're a guy now into the office. You put on a different pair of their pants to go to the gym. It's pretty amazing. So it seems like people really enjoy the brand. That slippage you're talking about, though, in the happiness score. What are you looking to hear from them, with earnings, right around the corner? Right? What are you looking to hear from them in terms of guidance to kind of stem that? And do you think that if people hear the right thing from them, that ticks back up? Or do you think this is truly just supply and demand and no product means not a pleased customer?
You know, whenever we look at the actual mentions of these tweets, you know, because we're looking at what the consumers are talking about, the most common, you know, cause of negative sentiment, at least recently, tend to be related to those sold out mentions. So people who are talking about they can't get their hands on the product that they wanted, or the color that they wanted, or the specific, you know, type of short or pant that they wanted. And so I think that that is kind of this lingering supply chain, maybe product shortage issue that they kind of hinted at. But what we see is that those purchase mentions on this chart, I think, is really cool because you're starting to see that inflection point. We saw some just loss in momentum whenever it came to, you know, consumer demand and how enthused consumers were about shopping with Lulu over the last couple of quarters. And those 2 quarters that I have highlighted really shows a reversal. And now they're reporting on that Q4, so that second to last bar. And you can see definite improvement versus Q3. You know, we would expect this into the holiday season. But then what's really interesting is they're continuing to build on this in the current quarter. And just for reference, we're about 2 months in already on that, you know, that first quarter of 2022. And so this is a really nice pace for Lululemon. I think that is currently measuring out about 19% higher on a year-over-year basis. And this is something, you know, this is just a trend reversal. So for us, this is an interesting inflection point and tells us that if Lulu is able to, you know, meet the consumer demand is certainly there and it's building.
Yeah, and Megan, and we know about the inflationary pressures, the supply chain issues, the raw materials that they're using for their products. Those prices are going up, right? It's already at an elevated price level point for a lot of people. But I kind of wanted to hit on this, the new phenomenon, the shoe, right? I know you're a runner. I've been wearing the same brand and model of running shoe for the last 15 years. I'm not going to change for that. But you guys are seeing positive mentions there. Now, we've seen shoe companies come and go trying to compete against Nike and Adidas, and they just kind of fall by the wayside eventually, and they don't get any traction. Is that what you expect? Is that what you expect here, or is this something that because people are so brand loyal to Lululemon, they'll keep trying this out?
You know, this is an instance where, you know, I am a runner and I missed my chance to get my hands on these shoes. I'm like devastated. They're already sold out in my colors. They're sold out in my size across the board. I even would have gotten a color that I didn't like just to try these out, because just in the mentions that we're looking at, the reviews are extremely positive. People are talking about, you know, if it's possible, these shoes feel like butter. They feel the same way that the Align leggings make me feel whenever I'm working out and when I'm wearing them. So I think that, you know, you made a good point that a lot of other companies, one that comes to mind is Under Armour, that tried to get into shoes and they didn't really execute, right? They didn't do a good job. We saw mentions of people talking about wearing Under Armour shoes and it hurting their feet. This is not the case with Lululemon. The early mentions of people who were lucky enough to get their hands on these shoes are extremely positive. They talk about them being extremely comfortable. They talk about the material being high quality. And I think it's interesting because if you listen to comments from their, you know, product team, they talk about that they're, you know, these shoes took 4 years to develop, that they did, I think, 1 million foot scans, and that when they were developing this, you know, this is one of the first shoes that was actually developed based on, you know, women and women's feet. A lot of time, shoe companies, they develop based around the man's foot and kind of adjust to fit women's sizing. And this was kind of a reverse because, you know, Lulu knows their audience. And they also know that maybe, you know, maybe if a woman picks up a pair of these shoes, they'll want to buy a pair for, you know, her husband or her boyfriend or, you know, her partner, whoever. And so I think that this is really interesting, but at least from our data perspective, it appears that this could be a little bit of a spark that maybe Lulu needed as they started to kind of lose some of that momentum to kind of, you know, reinvigorate their consumer base and introduce a new product. And so far, you know, the most negative things are just people talking about that they can't get their hands on the shoe, like me.
Yeah, and I think, you know, you might want that Lululemon emblem on the side of your shoe. That because half the people here in Chicago that are wearing Lululemon never working out in that Lululemon outfit ever, but it's all about brand recognition and quality of product. So I like that angle that you used, that they did a lot of research before they actually came out with a product. But now going into earnings here, Megan, are you guys positive on the scores? Because it seems like the trend is kind of reversing the past couple quarters.
Yeah, I think that we're in the early moments of this kind of reversal and the spark for Lululemon. Our score is coming in bullish, slightly bullish. It's a 29. I think that for comparison, last week, whenever we talked about Nike was a 37. And part of that was just because of how much happier they're making their consumers. And, Lulu's consumers are already pretty happy. And so I think that from our perspective, we are definitely leaning bullish into this event, acknowledging that maybe in the quarter that they're reporting on, they're not going to have a lot of this, this new product energy to hit on. But, we do think that they will be able to make some nice nods toward guidance and potential sales moving forward.
Yeah, and you guys were spot on that Nike call, too, because that stock has rallied post-earnings and hitting highs post-earnings from where it was prior to that. All right, great stuff. As always, Megan, appreciate it.
Thanks, guys.
All right, that's Megan Brantley, the Vice President of Research at Likefolio. Now, Nick, let's take a look at Lululemon going into these earnings. The stock got beat up pretty good from those highs that we saw last November. It's bounced off of that. It's back above its 50-day moving average, still below its 200-day moving average at this point. But when you look at this, implied volatility really elevated. This is a high-price stock, Nick. I mean, using the option market might be the way that some traders or investors look at this, just due to the high price of buying 100 shares or 50 shares of this type of stock. Anticipate a market maker move about $23.50 here, plus or minus either way. Break down the example trade that you brought to us based on Likefolio is pretty positive on this this name going into earnings.
Yeah, look, I think Lulu, just to touch on the earnings piece for 1 second, Megan said it perfectly right. They know their audience. They start with a ton of research, but there's a lot of revenue streams out there that they can still tap into, right? Like men's shoes. There is no men's shoes. So unlike you, Tom, I'm always trying out new running shoes, and there's a lot of cool new brands out there already, and I think they see a huge opportunity in that space. And there's a lot of other elements they can get into. And then as you blend these types of clothing with work and workout together, I think there's a lot of interesting kind of collaboration and sort of cross-stitched, if you will, products out there, no pun intended. But so I saw Megan's information, a bit ahead of time and kind of went over that, and I agree. They are positive, not as positive to her point as Nike, but it's a little bit of a different audience, and the brand loyalty, I think, is every bit as strong if you know people that know it. It's just a little bit more of a niche brand still. So I kind of took that into account. We are up almost 20% off of the lows, right? So yes, we're well off the highs, but we've bounced 18-19% from those lows as well. So a little bit middle of the range. I think it's all, as I say this every time we talk earnings stocks, I think it just comes out of the guidance. The numbers already happened. How are they guiding? How are they going to meet the demand? Are they developing a men's shoe? Where is that going to fall in? Like, what is the outlook for this company in terms of the next couple of quarters? So I set up a call diagonal, selling that front week volatility with earnings being captured there. It is a very high vol, to your point. So 103 vol, predicting about a $26, $27 move. And then I went out to the April monthlies, and I was buying the 365 call. So there's a diagonal component to this spread. Buying the 355 calls. And what that's doing is giving you a $10 wide vertical that you're purchasing, but you're still taking advantage of that higher front week volatility. So you're getting more of an offset with just a very short-term trade, but you still get that $10 wide vertical component if the stock does rally to the upside. The other nice thing about that is you've paid some, right, with a real high vol, you've paid a bit more of the cost of buying that longer dated option, and you still have the ability to roll 3 times. Plus, then you can turn it into just a vertical in that regular way April expiration. So you've got a little bit of ability to adjust this, and you've got room to run to the upside because you're purchasing that vertical component, which is a bit different than how we normally look at it. But the bullish example helps use that front week volatility to pay for a longer term call, and it gives you that verticalization that you can then maneuver from there.
Yeah, I like looking at strategies like this, Nick, where it's a call diagonal, and we talk about that sometimes on the show, but this is a little bit different because you're buying that slightly out of the money April 14th weekly or monthly series, which has 16 days till expiration, and then selling the near-term April 1st weekly 365 call that is about $20 out of the money to the upside. You're paying roughly about a $5.75 debit. That's going to be your risk. Your break even about 334, just above 334 on this particular trade. And with the apex of profitability being at that 365 strike, which is right around that one standard deviation anticipated market maker move that the option market's pricing in at this point. And besides that, Nick, because it's got that vertical component in it, you've got no risk to the upside on this one. All the way up past 450. I mean, this is set up as a bullish example trade. Your risk, as I mentioned, is what you're paying for that $575 per spread on this one. Now, you've got assignment risk if it does go up through 365 by expiration. Those expire in 3 days on the April 1st weeklies. But nice look at a different type of strategy here that takes a bullish stance. Now, if you're bearish, you can do this to the downside where you do a put diagonal to the downside. But this is just one way to look at it based on Likefolio's data, which is pretty positive going into this report, plus 29 on their score. All right, great example trade here, Nick, to look at Lululemon based on Likefolio's data. But coming up after the break, we're going to take a look at Five Below, which reports earnings tomorrow morning. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby. It's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. After some constructive comments from Russian and Ukraine negotiators, the euro's back above 111 and holding up around 1%. It's come under pressure in recent weeks with a hawkish FOMC compared to the more accommodative European Central Bank, and in response to its proximity to the war. The run-up in the euro sent the greenback to 98.05. Both the dollar and yields. Rates here in the U.S. have backed off recent highs. The TNX to 2.4 from 2.5% as we await inflation data due out later this week. The personal income and spending numbers Thursday. The jobs report Friday, where investors and traders will have a close eye on the wages component. Yesterday, Bitcoin spiked to 48,000, but limited today in terms of follow-through, which is odd when you think about it with risk-on environment we're seeing in the indices. The NASDAQ and the Russell both up over 1%, but maybe not when you consider how the move up we've seen in crypto has been more tied to Russia's war on Ukraine. Last week, Russia said they'd be willing to accept Bitcoin as payment for oil, and with peace talks progressing this morning, The same negotiator that called the talks constructive said he would look at Ukrainian proposals, report on them to Putin, and then a Putin-Zelensky meeting is a possibility. Bitcoin's down around 1% as futures are trading just above 47,500. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market with Tom White.
Welcome back to Fast Market on the TD Ameritrade Network. I'm your host, Tom White, along with my co-host for the day, and that's Nick Theodorakis, Financial Risk Management Managing Director here, or at TD Ameritrade. Nick, let's get into a discussion about Five Below. They report earnings tomorrow morning, and I should have gotten Megan's take on Five Below because we've hit that stock with Likefolio prior to that, and they're always pretty positive on Five Below going into earnings. Just due to their mix. They've got about 2,500 stores out there. The cost to open a new store is relatively low compared to competitors in the space, whether it's Dollar Tree, Dollar General, even getting up to Target, because that demographic that Five Below has as far as what people make a year that go to those stores is far above the discount retailers like Dollar Tree. Your thoughts, I hear what the market's telling you on Five Below, because it's pulled back pretty significantly from all-time highs in the middle of last year.
It has, and if you look at the earnings page within the Analyze tab in the platform, the vol is interesting on this one. So, it's kind of middle of the range, right? So they are significantly off their highs. I would expect, just complete sight unseen, right? Just hearing what we've heard and talking like we have for the last 45 minutes here, I would think there's a huge impact to their stores in terms of staffing, in terms of the cost of the products that they're putting out there. And when you do have a very budget-minded consumer coming into your store, I think you have to be very careful how you pass those costs along. So I think that's going to be, to me, the fascinating part about earnings, in particular the earnings call. How are they keeping up with the demand? How are they keeping stores stocked? How are they keeping stores staffed? And all of those things, right? They're a frontline retailer. All of those things are extremely sensitive to how their earnings are going to look. So I was interested to see that the vol isn't really as high as it has been on some quarters. It's certainly elevated, but not kind of to the moon like some of the vols that we've seen. They're looking for just over $1 billion in revenue on about $2.50 per share EPS. So, I think the numbers, I think can be skewed by a few things, right? What does the supply look like? Is it going to be a Lulu conversation like we just had, where there's demand and they don't have the products they want in the stores? Or is it going to be, hey, we were able to get this stuff stocked just right, and we sort of hit it out of the park? And those are kind of the bookends, I think, that we could see, Tom.
Yeah, and going into the retailers and what they're looking at, you always have to bring into the equation of inflationary pressure. So let's get to this example trade. And this is probably based on, an example as far as what Likefolio would give us. And it's the same kind of setup that you looked at before, Nick, in the previous stock in Lululemon, where you're doing a call diagonal. I did the same type of setup here, where I went out to that April 14th of the monthly series, buying the 170 strike call, and then selling the 182.5 strike call and the near-term options that are elevated as far as implied volatility goes, the 182.5 strike call and the April 1st weeklies. If I'm paying roughly about a $6.25 debit for that, that's going to be your risk, $625 per spread. That break-even point, just about 166.5 on this one, with the apex of profitability being basically about $12 above the current share price from that at or near that 182.5 strike. You do have that option to roll, as Nick mentioned, on the Lululemon, but that'll actually increase transaction costs, no commissions, but transaction costs on that, just minimal, would increase if you adjust it. But the idea here is that the stock grinds higher after those earnings results on this. The anticipated market maker move is about nearly 8% plus or minus either way, so that 182.5 strike sets up nicely based on the option pricing that we're seeing currently. But the idea here is that if the stock goes higher, now, if you think that the stock's going to go lower after earnings, then you could definitely do a put diagonal to the downside using the same option series on that. But that's a breakdown of another diagonal, slightly bullish on Five Below going into earnings. All right, that's going to do it for Nick and I today on Fast Market. But stick around on the TD Ameritrade Network as Next Gen Investing is coming up with Alex Coffey and Jenny Horn. Have a great day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
So what are you working on?
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
Wasted time is wasted opportunity.
Exactly.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. See, you just...
Oh, this is easy.
Yeah, and that's...
Oh, just what I need. Courses on options trading, webcasts, tutorials.
Yeah, their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Oh, exactly. Well, except now you're binge learning.
Ooh, I like that.
Thank you. I just came up with that.
You're funny.
Learn fast with the TD Ameritrade Education Center. Call 866-300-9417 or visit tdameritrade.com/learn. Get started today, and for a limited time, get up to $800 when you open and fund an account. That's 866-300-9417 or tdameritrade.com/learn.